War in the Middle East is currently threatening the global oil supply, and the ripple effects are hitting almost every asset class on the planet. When geopolitical tension spikes, investors typically execute a familiar playbook. It's called the flight to quality, the instinct to pull money out of risky ventures and park it in highly profitable, stable companies until the danger passes. But right now, executing that perfectly logical maneuver is causing investors to lose money. Surviving a massive macroeconomic shock to the energy market requires doing the exact opposite. It requires deliberately seeking out the lowest quality, most volatile stocks on the market. We can track exactly how this is playing out right now using both America's S&P 500 and the MSCI World Index. This chart tracks stock performance since the conflict in Iran intensified. The baseline here is the S&P 500. A sub-index of high-quality firms is actually underperforming the broader market. But a third line tracking highly volatile junk stocks surges upward, easily beating the benchmark. The data shows a massive disconnect. Relying on the traditional definition of a good company is blinding investors to where the actual returns are hiding. In finance, quality is a specific factor, an attribute that helps explain a stock's performance. High quality usually means massive tech firms that boast a history of stable, high, and rapidly growing profits. On the other end of the spectrum are low quality or rubbish stocks. These are companies in sectors like energy, financials, or healthcare, characterized by highly unpredictable, volatile earnings. If you look at the top tier of the S&P 500, energy companies make up only about 1% of those high-quality firms. But drop down to the lowest quality quintile, and energy stocks suddenly account for roughly 9%. The distinction between quality and junk centers on the market's perception of a company's future certainty. Let's look at a timeline mapping out corporate earnings to understand how stock pricing actually works. Investors determine a stock's price using valuation multiples, which measure how much you pay relative to a company's yearly earnings. When you buy shares in a successful tech giant, you pay a very high multiple. You are paying a premium because you assume that company will maintain rapid growth for the next 20 or 30 years. You are pricing in profits expected in the year 2054. Junk stocks trade at low multiples. They are cheap because their long-term future is murky. Their value is based almost entirely on the unremarkable, ho-hum earnings they will generate in the immediate next 12 to 24 months. Projecting global economics 3 decades into the future requires deep speculation, but projecting earnings for next year is tangible. A company may already have those orders locked in. Purchasing a high-quality stock effectively functions as a speculative bet that the global order remains stable for decades, and nothing shatters the assumption of global stability faster than an oil shock. Energy feeds into the production of practically every physical good. When crude oil prices spike, it immediately acts as a massive tax on the broader economy. Growth slows down, and consumers can afford to buy fewer things. Then comes the secondary effect. Governments feel pressured to offer subsidies to offset the impact on their citizens. That strains national budgets, heavily impacts the government bond market, and alters currency values. An oil shock is never contained to the energy sector. It injects severe macro uncertainty into every single asset class simultaneously. Let's look back at our timeline. When severe uncertainty hits the market, the distant future goes from looking highly profitable to completely unpredictable. The certainty of those projected 2054 profits evaporates. Because those tech giants are so expensive, their high valuation multiples violently contract. The long-term future they were priced for no longer exists, bringing their current stock price down with it. Meanwhile, the exact opposite happens to the volatile energy stocks. Their immediate near-term profits are sitting right there in the present. Because investors can clearly see those earnings right now, they rush to buy them, driving the stock price sharply upward. Finance is filled with confusing terminology. Terms like investment grade, forward guidance, and quality sound reassuring, but they routinely trick retail investors into clinging to the wrong assets during a crisis. The mechanics of market valuation create a specific paradox. During a panic, prestigious firms can generate negative returns, while volatile energy stocks provide the only reliable growth. There is a strict limit to this strategy. Markets are ruthlessly reactive to the physical realities of geopolitics. If the geopolitical conflict abruptly ends, the Strait of Hormuz opens, and oil starts flowing freely across the ocean again, the entire pricing inversion will snap back overnight. The high multiples will return. Until the supply chains stabilize, the most reliable protection in a panicked market comes from companies generating tangible, immediate profits rather than prestigious brand names.